Everybody talks about the upcoming market crash this year or next year. Do you think this will happen and why? Great question. Yeah. I never think of it that way. It's too hard to call the market. A lot of hedge funds went bankrupt last year for being negative on the market because of COVID. It seemed logical, right, from a short-term perspective. Things are not going to be good in the world, so stocks go down. But they didn't. They went up. The market can stay irrational longer than we can stay solvent. Yeah, and I worked for this wonderful man, God bless him. His name is Art Sandberg. He passed away recently. I worked for him at a great hedge fund called Pequot. And I remember back in '06, we were looking to short Lennar and KBH, ticker LEN and KBH, home builders. The reason was because of the housing crisis, and we wanted to short private equity bubble-based companies. And he said to us at the time, I remember that, Art Sandberg, God bless him, he said, son, I've been around long enough to understand not to stand in the way of insanity. Markets peak, markets trough. You can never call the peak or the trough, which is why I love to be a long-term investor, because it works much, much better. Yeah. In terms of why the market has been up in the face of all this negative news over the past, year and a half, whatever it is. Well, governments have, there's two sets of medicine that governments have to fix an economy from a finance perspective, nothing to do with COVID. And the two sets of medicine that governments have are, number one, fiscal policy, and number two, monetary policy. And let me explain what that means. Let me kick it off with monetary policy, which, as the name implies, is the policy of money. And that means that governments, when they're worried about the economy, they cut interest rates. Let's pretend that I'm the government. I'm the U.S. government, okay? And you're all consumers. And I have a bond. And bond is just debt. It's like you getting a loan, but it's for a country or a big company too. I'm the government, and I have this bond, and I'm going to sell it to you. Why are you going to buy it? Well, because there's an interest rate on it. You'll make money. It'll be a good deal, and because it's U.S. government, you trust them. Okay. So here's this bond, and you're a consumer. All of you on this webcast, you buy this bond because it's a good investment. In return for taking this piece of paper, this bond, I take your money. Okay? Thank you. Now, I take that money, and a lot of it I take out of circulation. And some of it I use to build, bridges or defend the country if there's a war, God forbid, etc. Okay, so a lot of this money is out of circulation. So all of a sudden, there's less money out there. So what that means is interest rates go up. The demand for money goes up. There's less of it out there, man. So and basically what happens is when the government wants to slow down the economy, they'll do that. Okay, they'll sell bonds. In return for you getting the bond, you give me your money. I take it out of circulation. Now there's less money out there, and interest rates go up. Now, the inverse is true too. When the government wants to stimulate the economy or help it, what they do is they buy back bonds, right? So what I do is I take some of this money and I buy your bonds back from you, okay? And then what happens is you give me the bond back, I give you money, okay? And so all of a sudden there's more money out there in society. And when there's more avocados out there, the price of avocados goes down because the supply increases. And when there's more money out there, the price of money goes down, meaning interest rates go down because there's more money out there. And that helps the economy. And fiscally responsible governments or Federal Reserve chair people, what they usually do is they increase interest rates a bunch when times are good. It's smart to do that. Smart, not too much, but a bunch. It's smart to do that because when times get tough and the economic cycle, it can be 5 or 10 years, the economic cycle. But when times get tough and we're in the downward trend in the economic cycle, meaning a recession or whatever it is, then what the government can do is they can jumpstart the economy by cutting interest rates. One rate cut, another rate cut, a third rate cut, etc., until the economy improves. And then it gets better, and then rinse, lather, repeat, the government raises interest rates. Okay, that's the economic cycle. That's the way it should happen. Let's move on now to the other medicine that governments use to help the economy. Okay, and that's called fiscal policy. So monetary policy is the policy of money. It just means interest rates. And everything else to help the economy is called fiscal policy. Fiscal policy means doing things to help the economy, like cutting taxes, not interest rates. So you can cut taxes, okay? Or what you can do is you can create stimulus programs where you can cut a check for every American that needs it, or every person in the world, depending what country you're in, that needs it. Or what you can do is you can start these big construction government-sponsored projects, like highways, for example, which really stimulated the U.S. economy with the Highway Act in the 50s and 60s. Yeah. So that's what you do. When you run out of both sets of medicine, then things get crazy. Things get crazy. Desperate times call for desperate measures, and governments start doing things they've never done before, or they rarely do. So, for example, in 2008, when we were within 24 hours of bank machines not working, what the government did was they made it illegal to short 800 stocks, right? Like a lot of banks I was short, and I never covered, right, until the next year at least. Thank God. Yeah.